Welcome to Key Points for June. This month, while we've got greater conviction in our growth forecast for the year, why the further spike higher inflation should not be extrapolated and we suspect will be transient, and why following a very modest pullback we believe there's further upside for equities. Now to the first point, our growth thesis for this year was really dependent on a transition from the industrial manufacturing part of the global economy towards the service sector, which of course we've seen a lot of excess capacity in. Now the very latest data imply that transition is beginning to occur. When we look at Europe, we've seen the Eurozone services PMI move back above that critical 50 line, back into expansionary territory, where of course the manufacturing sector has been for some time now. In the UK, the services PMI reading is even stronger. And again, when we look at business confidence has been surging, and within sectors, the hospitality sector, for example, around lodging, around restaurants, around pub chain, also show very strong demand and footfall, implying that indeed consumers are moving from the goods part of the economy towards the services sector as these economies open up and freedom of movement comes back into play again. Now, this is critical for two reasons. One is that we need this broadening of growth to keep the momentum in the global economy moving forward. Of course, we need to see the service part do better in other parts of the world as well. But what we've seen so far is encouraging. And secondly, the broadening of growth, shifting demand to the underutilized part of the economy, removes some of the pinch points, the pricing bottlenecks that we've been seeing. And again, that's quite encouraging as we look further out in the year. And that takes us to our second point, because there is no doubt inflation numbers have spiked higher recently. In terms of the US, we've seen headline CPI at 4.2%, the core reading at 3% year on year. These are much higher than we've become accustomed to in recent years. But again, we think there's factors behind that that are going to be largely transitory. For example, we've seen commodity prices, particularly oil prices that were artificially depressed last year, they have normalized, and not surprisingly on a year-on-year basis, we see a big pickup in prices, and of course that feeds into different parts of the economy. Within the core readings, things like used car prices, we've seen airfares, hotel prices have all picked up. But again, as we have more capacity coming on, as the economy broadens, we think by the end of this year, some of these pressures will begin to alleviate. And let's be clear, if we're wrong and inflation proves more persistent than we're expecting, the central banks have not lost their inflation fighting credentials. So they will start to ease back in liquidity and start talking more about when they're going to be moving rates higher. Now, when we turn to the third point, last month we had spoken about expecting a bit of a pullback for equity markets, that we thought would refresh this bull market. Now, what we saw was minimal, to be honest. We saw the tech-heavy NASDAQ pull back 7 or 8%, but the broader S&P was only off 3 or 4%, and many other global markets were off even less than that. So we haven't quite seen the consolidation that we had been wanting to see, but actually we are encouraged by the fact that levels held. Investors were buying on dips. The Fed were quick to appease concerns around inflation and still speak in a dovish rhetoric. And as a result of that, as we look forward with a very strong macro backdrop, with corporate earnings likely to be seeing very strong readings and revisions to analyst expectations, we believe the direction of least resistance for equities is again higher. Remember, as always, you can read the full report on zurich.com/MSME.